In 1910, under the cover of night, a group of powerful men boarded a private rail car in secrecy. They used fake names. They told no one where they were going. Their destination? A secluded island off the coast of Georgia, Jekyll Island. What happened there would shape the financial destiny of the modern world. No public vote, no national debate, no referendum, just bankers designing the rules of money itself. Today, that system influences interest rates, recessions, inflation, even the price of your groceries. Here's the question: how did a handful of unelected bankers gain control over the global economy? And more importantly, why were you never asked? To understand the cartel, you have to understand the panic. In 1907, America's banking system collapsed. Banks failed. Depositors rushed to withdraw cash. The stock market crashed nearly 50%. The entire financial system teetered on the edge. There was no central bank, no lender of last resort. So one man stepped in, J.P. Morgan. He gathered the most powerful bankers in New York and personally orchestrated a bailout. It worked, but it exposed a terrifying truth. One private banker had more power than the U.S. government. Lawmakers panicked. They wanted stability, but they also wanted control. So they created a new institution in 1913, the Federal Reserve System. Officially, it would stabilize the economy. Unofficially, it centralized financial power in ways most citizens still don't understand. Here's how the system works. Imagine the economy as a giant casino. Banks are the players. The public supplies the chips, and the central bank, it controls the table rules. The Federal Reserve System sets interest rates. It decides how expensive money is. Lower rates, borrowing explodes. Higher rates, spending freezes. It also creates money, not by printing stacks of bills, but by typing numbers into digital ledgers. When it buys government bonds, new money enters the system. When it sells them, money disappears. This is called open market operations. It sounds technical, but it's simple. The Fed can expand or contract the supply of money at will. And America wasn't alone. Central banks spread across the globe. Eventually, they coordinated through an institution few people talk about, the Bank for International Settlements in Switzerland. It's often called the central bank for central banks. No elections, no campaign promises, just monetary policy. And here's the twist. The Federal Reserve isn't fully public. It's a hybrid system. Regional branches are technically owned by member banks, private institutions, which means the institutions being regulated also have a stake in the regulator. That's not conspiracy, that's structure. For decades, the system expanded quietly until 2008. The housing bubble burst. Banks were over-leveraged. Mortgage-backed securities imploded. The financial system froze. Lehman Brothers collapsed. Markets panicked, and the central bank stepped in again. The Federal Reserve System launched emergency programs. Trillions of dollars were injected into banks. Interest rates dropped to near zero. Quantitative easing began. Assets soared. Stocks recovered. But here's the uncomfortable question: who benefited first? Banks stabilized immediately. Wall Street rebounded. Meanwhile, millions lost homes. Unemployment surged. The rescue worked, but it felt uneven. To many, it confirmed something unsettling. When crisis strikes, the system protects itself first. After 2008, a new era began. Cheap money flooded markets for over a decade. Asset prices inflated. Stocks, real estate, tech valuations. Wealth inequality widened dramatically. Those who owned assets grew richer. Those who lived on wages fell behind. Then came 2020. Another crisis, another intervention. Stimulus on a historic scale. Money supply surged at record speed. 2 years later, inflation exploded. Groceries cost more. Rent climbed. Energy spiked. To fight inflation, rates rose rapidly. And suddenly, banks again faced pressure. The cycle repeated. The same institutions, the same tools, the same concentration of power. Supporters argue central banks prevent depression. Critics argue they manufacture booms and busts. But one fact remains: a small network of monetary authorities shapes the global economy more than any elected official. And most people don't know how it works. This isn't about villains in dark rooms. It's about incentives. Power centralizes during crisis, and once centralized, it rarely disperses. The banking cartel isn't a secret society. It's a system, one designed to stabilize, but powerful enough to distort. The real question isn't whether central banks should exist. It's whether citizens understand the levers that control their money. Because in a democracy, secrecy. Ignorance is the most expensive tax of all. If unelected institutions control interest rates, money supply, and crisis bailouts, who really runs the economy, and should they? Tell me what you think in the comments.